Okay, hello, welcome. SmartHelping.com live financial modeling. We've got a real tough one this week, and I was thinking about skipping it because it's pretty good how it is, and I've gotten great feedback on this mobile home park model in the past. I mean, from guys who've been in the industry for 20 years, said this was the best off-the-shelf model they've ever seen. So it's really good how it is, but what I'm gonna do, and there's not a whole lot I can add as far as a cap table because it's really structured as a joint venture with these waterfalls. So I'm not going to do a whole lot there. I'm not going to do a whole lot with the normal tabs you see me add to this, but I will be doing income statement, balance sheet, and cash flow statement monthly and annual. That's going to be an addition. I'm going to have to use the monthly detail to populate these figures. And we're also going to do a lot of logic with depreciation because with these mobile home parks, that's a huge deal. A lot of times you'll get bonus depreciation or have things where you can take a lot of the costs um, up front, which does help offset some income and you can carry those losses forward. Um, but there's, a lot of that's going to be up to your accountants. But I'm going to put some logic in here that at least shows potential depreciation expense that can be deducted based on, and this model allows you to model up to 40 mobile home park acquisitions or development. So this could be, right here in this column is construction or other. This could be development. There's also logic for the acquisition. If you're acquiring a park with a given NOI, your entry cap is whatever. This is your acquisition cost. And you could have um, improvements, etc., which is all depreciable uh, expense things, or you could have only one or only the other, whatever the case is. So we're going to get in all that, and we're going to try to flow this through a three-statement model. It's going to be very hard. Uh, the control tab is probably going to stay how it is. It does allow the user to, determine. We're going to do start year. We will probably change this logic to just a hard-coded number for the year, whatever that might be. I'll have to update the tabs after that. You have exit month, exit cap. Now on the exit, it assumes all of the parks that have been acquired are getting sold. This is what's driving the sale. You can also determine if any of the parks you put yes in the debt column, it's going to use this for your initial loan, which does have an interest only period option. So like if I put 12 in here, we go over the amortization schedule. Well, we'll have to update the dates actually. Let me do this real quick so I can show you. Um, so now it's just going to be date of this. Okay. Um, but you can see interest only periods. So interest paid for the first 12 months on this one, and then it goes P&I after that. And then you can also model out on the exit a refi, or I mean, sorry, in the middle of it, you can do a refi, which is again, the global control determines all logic for that refi. If you hit yes or no here, it won't do it. If you hit yes, it will, based on LTV, the year you're refining relative to the purchase of the initial park, which all of them could have different dates. This will apply dynamically to each one. And then the refi terms, uh, and then obviously the exit up here will drive the exit. But this amortization schedule has all 40 parks and it is all dynamic. So there's lots of cool logic here. I have this in one of my top templates at smarthelping.com in terms of logic. Right here, scaling it up to 40. There is a light version that only has 5. That's not getting an upgrade. So only the 40 park version is getting the full upgrade. And this is part of the industry specific model bundle. If you want to buy it with that, it's $4.99, or you could buy the mobile home park by itself for $175 as a one-time fee. As you know, I've been going through and upgrading all the startup models. Industry specific and SaaS are where you'll see most of them for now. I'm on number 13 or 14, I believe. So we're just grinding through it, trying to make everything better, not increasing prices on anything. Um, so you know, we're going at it. Don't forget to subscribe to the channel, by the way, like the video, and um, share these things because I feel like there's a lot of value here. Um, a lot of value here if you're doing mobile home park acquisitions and operations. Other stuff in the model, just to go through a quick overview, is you've got different things for unit counts, weighted average lot rent, which would be the weighted average of the whole park, lot rent growth, stabilized growth, initial occupancy, improvement occupancy, stabilized occupancy. Um, so the unit counts your maximum potential units of the whole place, and then this occupancy logic here defines how quickly and what maximum occupancy you reach of whatever you put in here for units. There's also expenses, and you could define these, but I just put some general ones, third-party contractors, turnovers, repairs and maintenance, marketing, management fees, real estate taxes, sewer, water, electric, and some extra fields. There's also options for other income for the park, annualized, which will spread through the different park sections. There's a net operating income for all 40 parks. On the monthly detail here, you can see how that goes. Um, the total mobile home parks will flow across the top here. Actually, I'm going to unfreeze and freeze that because this is aggregate consolidated over time. Here, we're just adding one park a month for the first 40 months. And you can see mobile home park number 1. It's got operations, occupancy, active units, average lot rent, growth, potential rent, vacancy loss, gross rental income, total gross income. Now this is going to be hard because I'm probably going to have to pull these specific values, so I'm going to have to make these unique to each park number. Well, no. I will be summing up the aggregate, so that's fine. Then you got your OPEX, net operating income for the park, valuation for a refi for the reference of that, initial loan amount, principal interest paid, debt service, refi, exit, and initial cost. So that's basically everything you see, and that's just iterated 40 times. You can hide and unhide this to make it a little bit easier to go through if you just want to see the high level items. And then at the bottom is the consolidated of all 40 parks, so net operating income, cash flow. So all this stuff, we're probably going to be referencing some of it, but the point of putting it into a 3-statement model is really a more formalized report view. I'm not taking away any logic that already exists. I'm just adding basically these 6 tabs here, and it's going to reference all this other data that's already existing and all these assumptions. So we'll see how this goes. This is going to be a hard one. I know it. I know it's going to be, and I think to make it worth the value, um, I need to add in depreciation logic, so I'm gonna have to look that up actually. And let's see. So first thing I want to know before I even get into this is, can I depreciate a mobile home park acquisition? Oh, let's see what the internet says. I just need some general rules here. All right, so what's this? A good portion of land value based on tax assessment, which can be as low as 20%, high to 80%, is something that investors should consider in a property acquisition. Property owners should take into account mobile homes. So this is going to assume the park is either acquiring an existing park where there's no park-owned homes, or they're building the whole park from scratch and including all the mobile homes and everything. Now, in that version, so see, this is where things get crazy with these mobile home park models. In that version, we're not, well, to do that, I would have to split logic up. I would have to say, like, if you're built, let's say you're building out a new park and you're building out all the units, all the utility infrastructure, everything, and you're putting all the mobile homes in there and you're selling them to residents and allowing them to finance a ton. It gets really, really complex on the financing side. It's really difficult. It's not as hard to say, if you just sell them, if people are buying them with cash only, but usually people will be financing, and then, there's just so much logic there. It's too hard to scale it. So this model, I'm thinking, what can we do? We can probably assume a percentage of the total units are sold, and I can do a little schedule, and I guess I'll have to update the monthly detail here. That'll say, actually, I'll just do, so this is just operations. So collecting rent from the lot rent and running the mobile home park. So this is like one park. Here's park number two, and it's just the operations of the parks. And it doesn't really have anything to do with collecting money from selling the mobile homes to residents. Now, if you're acquiring a park, well, the park might have all the residents own all their mobile homes, and the acquisition, the acquirer is just buying the essentially the property, the land, all the infrastructure, collecting the lot rent. They don't care, the mobile homes are already owned. There's no um, logic that needs to be done there. That's what currently exists. So I'm wondering if it is relevant enough to add logic here that says, how many of these units, like if it's, let's say it's a new development. Let's say you're a mobile home park developer and operator. So you develop, all your costs are going to be in here. There's going to be no costs here. Develop all of them, build all the homes, everything else, and then you sell them or rent the home itself out on top of the lot rent, which you could do. So that'd be a lot to do. Um, that'd be a lot to do. And I'm thinking if the model needs to handle that, um, because the cost is fine. We could just have a cost in here that represents all of that for each different park, if that's what the park is. Because you could have some that you're acquiring, you could have some that you're developing, and that was the point of the model, is to be able to do both, or either or make improvements. Um, the question is, how do we account for revenues on that? And I think if you were renting out the actual mobile homes, you could add that in those starting weighted average lot rent. So let's say you're charging X amount for the lot and then Y amount for rent for the mobile home, and you add all those up for all the different units based on your unit mix, and then you get one final weighted average lot rent, and so that would be what shows up here. And in that case, this would work fine. You just have to make a note or make it clear that this includes lot rent and home rent. The trick comes if you're trying to sell the mobile homes individually, and I don't honestly think we're going to worry about it. I don't think we're going to worry about it. We are going to try and do some depreciation stuff with these two numbers, the acquisition and or construction. So in here, let's look at this. Which is something that investors should consider in property acquisition. Property owners should take into account mobile homes they own and other structures on the site of the RV park, such as a clubhouse, laundry facilities, management quarters. A good portion of mobile home parks can be allocated as 15-year depreciation. Most of the improvements in these properties qualify for 100% bonus depreciation, which means that 60-80% of property can be depreciated in the first year, which is fine. I mean, the first year you're not going to have that much revenue, so I mean, you're going to spread it out to future years anyway. The IRS recommends that property owners and investors have an engineering-based cost segregation study to determine which portion of the property can accelerate depreciation. We're not worried about that. Benefits and study are based on when the property was placed into service and updates made to the building in that time period. So what we'll probably do for this is say, here's your cost basis. These two numbers are the total amount of money, column J here, total acquisition slash development cost is here. And that's your basis for the asset value of the whole thing, the whole park. And then, I mean, I guess we assume some useful life. This is saying 15 years. Or maybe if there's, there's going to be so much nuance here. You give this to 50 different CPAs, you're going to get 50 different tax returns that have 50 different numbers on it. So, I mean, I think the best way to do it is just say this is your cost basis. And that's the cost basis, and we're just going to give it some depreciation. Like, and this is important to figure out how we're going to do the balance sheet structure. So you have this over time, this will add up and accrue. There will also be depreciation over time. And then the tricky part comes on the sale. I guess I'll follow, I think in the other templates, I just zero out any of the CapEx, and then because part of it can be assigned to fixed assets, part of it can be assigned to other comprehensive income. Because again, one of the big improvements I want to make here is add in some tax stuff with the depreciation. I'm not doing carry forward though, so I think I'm just going to, instead of doing the bonus depreciation, I'm just going to allow the user to enter a useful life, and that will spread out the depreciation cost over that many years for each one individually. And at least you get some idea. And if you want to if you think, you know, you'll have the slots where you can manually update it if you say, 80% can be depreciated year one and 20% over time or whatever. You'll have the slots where you can manually change those numbers and it should be fine. And then at the exit, the key is the exit. When you sell these, some of that sale you could be selling as, the property, the lots and all that, which has some cost basis based on what's been depreciated. And then you're also just selling the operations, the business itself, which is like, the operations here. So, so there's the biggest tax thing is really in the startup portion is how much you get to deduct off the bat for the first few years. How's that offset everything? The exit's not as uh, an immediate as an immediate concern, but we'll get some stuff there. All right. Well, so we're not going to change any of this logic. Again, we're assuming the average lot rent. If you're selling, if you're, it can account for renting out the homes and the lots together. You just have to put in whatever the weighted average lot rent is here against total units. There's going to be no logic for selling park-owned homes, like financing it, doing seller financing and all that. Um, I've done it before, and it's really complicated, and I don't want to do it in here. And I don't think it's material enough to meet the scope of what I'm trying to upgrade this to right now. So, all right, let's paste in the logic here and just start. So income statement. The main thing I just want to do is get a three statement model integrated in some form or fashion. into this. Just it'll honestly be really good just for the purpose of giving an overview in accounting terms of all different spots, and it'll make it a bit the model a bit easier to digest to like someone who's looking at this as an investor and they just want a quick high level view of all the line items, because right now the monthly detail, all that's really nice and neat, but it's not organized in a three statement model. So it might be a little bit harder to digest at first and take more time in the three statement model. Somebody knows exactly what they're looking for. So we're going to try it here. This is going to be hard. I mean, this is going to be really hard all week. I'm going to be sitting here banging my head against the monitor trying to make things balance and make it make sense. Also, this is only 5 years, so we're going to have to go out to, I think, what is this, 15 years, 16 years, so we'll have to extend it as well. I really almost skipped this. I was going to go straight into the next template I'm doing next week. Hopefully I finish this in this week. Next week I'll be doing a ratio-driven SaaS model, which is nowhere near as complex as this. All right, let's just do some quick formatting. I'm not even doing the find and replace logic. I'm gonna have to rebuild all of the connections and everything for this because there's too many tabs that are not needed, and then just too many new things that are going to be needed. So it's just basically going to be from scratch. So that'll be good if you want to see three statement logic building. I usually don't do that much of that here. It's more of importing the logic and then trying to fix what broke. Right now I'm just formatting, removing grid lines, extending out the length of the columns. Then we'll get into it here. All right. Oh, we can do uh, let's do like company name. Come on. There's a lot of logic. A lot of logic happening here. Okay. Company name will be, MHP Acquisitions LLC. Okay. And then we can reference that into here. I'm also gonna have to change the date stuff for the top of the income state or the financial statements. All right. Excuse me. Change that to this. Now these dates, we're going to have to do start month, because we do want to automate the date formatting here. It's going to be this. End month is going to be oh, come on. This. Okay. So month ended. That's year ended as of month end, as of year end. Could do this the same one. Year ended is going to be here to okay, what do we mess up? Dang it. This is on I hate this. I hate these this is why I was so happy when I figured out how to do the find and replace on an aggregate basis, but there's just too much stuff in this model to do that. It's just gonna be too hard, so I got to do it this way. Alright, so all I'm pulling from here is the start month. And all I want from here is the end month. Okay, there we go. Year ended. Okay. This is year ended. Put a little colon in there. Balance sheet as of year end. So we'll just change the text. As of year end. Oh, we gotta update the dates here too. Let's do this is the easiest one to go. I think they're all run off the income statement. Okay, there we go. One. Okay, what did we miss so far? Oh, we didn't extend these columns first of all. And we're gonna have to also extend them for 16 years. This is fun stuff, fun stuff. All right. So this is good. That's good. Year ended. This is not good. As of month end. Change the text. Okay. As of year end. Month ended. Okay. I think we got all the dates up top dynamic now. Twenty 2022. 2022. This is not right. Let's get this referencing that. This also needs to reference this all the way across. Cash flow, same thing. All right, so our dates, our timing, our text at the top is all good. The next step is going to be, let's extend all these out for 16 years, and then we're going to start putting in the logic, which will be the fun part. Or we'll actually be doing some calculations. I drag this over. All right, so we're going over 16 years. It's 12. Okay, too far. We'll stop at GL. All right, GL. C, D, E, F, G. Wait, what? Where's GL? Why are we one off? Income statement GK. Should be November. Yeah, so go one more. Oh, gotta update the top section too. Shoot. All right, so this is gonna be here. Check, see. Wow, nobody. No viewers. Slow. It's a slow Monday, I believe. That's okay. Most viewers end up coming in over time to view this after it's been live. All right, let's copy and paste. So that is going to go into the cash flow as well. Okay. And then let's drag this over. Also, I better make sure my audio and visual is on. Let's double check. It looks live. Test. Yep, that's good. Okay, great. Five, six. Okay, what are we doing here? We're off by 1 month on the year somehow. Should be 192 and 16. How are we off by one? Happy Monday, man. Happy Monday. Somehow we referenced one sell-off, so we'll redo that. There we go. Let's get this over. Okay, 16 years. Let's make sure this one, so this one was done right, and obviously this income statement was the source, and that's good. Now let's go to annual. So we got 5, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 6. Same thing here. 1, 2, 3, 4, 5. Oh man, this is going to be a fun one, I'm telling you right now. All right. So, income statement. We have two revenue streams, rental income and other income. Now, to calculate rental income, we go sum ifs. Let's look at our monthly detail here. Sum if all of this whole column. If column C equals potential rent. Lock column C. And now we should be able to drag this over. Now the question is, potential rent. We'll have to add in vacancy loss, and then other income is good. I just want to make sure, let's go down here at the bottom. I just don't make sure I'm not double counting. No, perfect. Okay. So we got potential rent. We've also got same thing, but other income. Great. And then nothing here. Oh, wait, no, we could do, so here we could do vacancy loss as, so we'll do total potential rent. And here we'll do vacancy loss. And then here we'll do gross total vacancy loss. And here we'll do gross rental revenue. There's no cost of goods sold here. Yeah, that works. So maximum rent. You know what? Yeah, because I always see real estate guys always put maximum, and then they put, or real estate modeling, they always want to see maximum rent, and then loss to vacancy. Okay, so total potential rent, and then here we'll have what are we calling it on these? Vacancy loss. Okay, and we drag ourselves over. And we drag ourselves to the end. So this is doing if that's greater than, and we're gonna go. Actually, that logic should already be in the monthly, I believe. Let's see. Let me just end this at 1 month earlier and make sure. Well, this goes to 0. All right, so we just have to add in the logic for vacancy loss. That's fine. All right, so if this is greater than our end month, 0, otherwise sum it up. And here is just going to equal this. Perfect. So put that logic on here as well. If this is greater than here, now the annual income statement will be pretty easy. Up, and let's do some potential rent, sum up this. Okay. All right, this looks good. Next up, so we have OpEx, but let's think about how we want to put this in here. So OpEx, we could do total operating expenditure. Let's try that. So same formula up here. We're going to go total operating expenditure. Okay. And then sum up here. Now, let's make sure this looks good. Should be all balanced out at the bottom. True, true. Okay, good. So there's some sanity checks in here we did. All right. So EBITDA should match our net operating. We'll change. That's fine. EBITDA is fine. Let's add this up and see if it matches our monthly detail. That's the key. 375, 355, 517, 375. So it would be we don't want to ruin debt service yet. Cash operating cash from operations. Okay, completely different. So net operating income is just taking gross rent or gross revenue minus operating expenditure. So let's just look at year one and see what's going on here. 952, 182. 952, 182. We have 2.5 million. Okay, so obviously something's wrong here. So this side note's different. That needs to be plus since we're adding a negative in there. That should probably be the difference. Okay, go back in 723,088. Nope, still different. All right, let's look at year one again. 952,182. All right, so that matches. Wait, 296,381. I think I sold the wrong column or row for operating income. 296,381. 296,381. 261.50. 261.48. Okay, good. So it's just rounding. All right. Well, good news is we have EBITDA of the consolidated 40 park thing model, and that matches our monthly detail. Very good. All right, let's look at consolidated interest. I believe we consolidated it. I hope. If not, what I can do is say sum ifs, column E, if column C is equal to, and then we'll go interest like this, which means it'll sum up any column or any cell where the column says interest in it over here. Now let's make sure we don't double count. So it'd be this one, interest. Let's look down here. Is there any interest? Debt service, principal payments, principal. We don't want to sum up this. So let's actually lock this in E1 to E. Let's just go to the bottom, 1887. Okay, lock, oh wait, leave that open, but lock C. And we're going to have to make sure that this matches. All right, so how do we check this? This is total debt service amortization only. Sum of principal, interest. I don't think I consolidated the debt service principal and interest out anywhere. Let's see, we got net operating income, cost, initial loan, refi. Okay, yeah, we just have the total debt service here, exit, net cash flow. All right, so we'll definitely have a check on it because I mean we just need to really make sure there's no other row with the name with the text interest in it, except for the one we want. So I think we're good. I don't see interest anywhere. Just right here. This is the only one we want anyway. All right, so that seems good. Man, no views today. No views today. It's all right. It's funny that some of this stuff, you never know what's going to be the most valuable, what's not, but this is definitely one of the most difficult and most valuable things I'm probably going to ever do. All right, so this is interest. Now, depreciation is where we get tricky. So we don't need any of this logic. We're good up to EBITDA. We're good on interest, interest expense. Based on all the different activity. So how do we do depreciation? We're probably going to have an extra tab just to do it. Come on, we're waiting. It takes a while to add a tab here with all the logic that's happening. Probably the hardest thing to do is the debt service, the dynamic debt service with refi on all 40 different things separately. That was tough. Okay, so we're going to take, remember, the total acquisition plus development as one full cost, and that's just what's going to be depreciated over time. So here we've got our months up at the top. We'll have reference our park names. 40, and see, this is where you can manually put it in if you want. I'm going to do it with a formula. Total depreciation. And on the income statement, it's just going to be one row. Actually, hold on. I don't want to mess with the spacing, but I do want to clear this out right now. So let's put it, we don't need this anymore. So how do we calculate it? Well, we need the basis. Let's give this another column. We'll have cost basis here. Just referencing this. Now we will have a slicer. Let's put in, because we were reading, there's a lot of caveats here, but we can say percentage that can be depreciated. So of this total acquisition and construction, what's the percentage that can be depreciated? Let's just say it's, 95%, whatever. It'll be depend on every single different situation. Totals. So cost basis. Actually, for this to balance, this is going to have to be always 100%, I believe, because that is a cash out item, and it's going to increase the asset value. This slicer makes everything complicated, so this is just, we'll do this as monthly depreciation, or no, we'll do annual depreciated per month. And here we can just say, let's say if it's 1/15th, it'd be 1/15 times 12. You know what's easier? Just put in useful life and years. That's easier. Let's just say 15. And it could be different for each one, whatever the case, but this is going to take the total cost and give you this amount of depreciation per month. Now we'll have to have start and end month. Start and this is mainly, let's say you were doing it over 10 years. Just so you can see, then the start month is always just it's going to be e-date, the actual start month of when you start buying stuff, and then adding the amount of months of revenue. So depreciation in this case would say start in March. So put a date in here. So that's start, and then end is simply e-date this, comma, and this times 12. And let's make sure that adds up to 100%. So start end, if we do if and this is greater than or equal to the start month, and this is also less than or equal to end month, then do do total cost basis divided by here times 12. All right. Otherwise, 0. Now, let's drag this over and see if we equal the right amount. And then if you had like 100% bonus depreciation, you would just say useful life is, let's see, I guess 1/12. No, we don't want a or we don't want a date. equals 1 divided by 12. So in that case, okay, so it would all come out in the rate at the beginning, but hold on. Before we can do that, let's drag this out for 16 years and make sure. We might have to say the end month is that month minus 1 to get, let's just see, hold on. All right, so total depreciated 369. Okay, too much. So this is this minus 1. Now let's see. 3. Okay, perfect. And then if this were to be 1/12, meaning it's immediate, there we go. And you get all the depreciation right up front. Or if you want to manually put it in how much you're taking on each one, that's fine too. Okay, so 10. Let's see, 3 needs to be locked as well. Now we drag all this down and over. And we should get the total depreciation per month right here. And that total should always equal the total cost base. Well, no, not necessarily. If, let's say the useful life is 15 years and some things are only active for, 12 years because they started in year 3 or 4 of the forecast. Yeah, in that case, you just have leftover. But if there's no leftover, then that should equal this. So it doesn't, let's see, okay, we gotta update the end date for all these. Now it does. Okay, so that's a good check. So this is good. So there's a total depreciation per month based on the acquisition schedule. Again, you could go in and change each one of these mobile home park name. You could go in and manually change the depreciation you're taking on each one by month if you want. Just make sure that it adds up to the total, whatever the cost basis is. And you should be fine. What next? What next? Let's see. So we have that. It's all dynamic. So depreciation expense, we technically could just go equals this. And that should equal our total, 446,666,666, 7, yep, looks good. Okay, all right. Now that's done. We now have taxable income. All these numbers need to be adjusted. So taxes on selling the mobile home park is the next logic piece we need to think about. Otherwise, the taxable income right here is pretty simple. It's just your EBITDA minus interest minus depreciation. And you can see these negatives. You're not going to have taxes for a while based on the current inputs. Probably until you stop acquiring places, and then once you're operational, stabilized, and everything, you'll have a positive net income or taxable income. But for now, so what I need to figure out is what do we do on the exit is the trick. And so we have let's say final cost basis is this minus the total amount depreciated which if we did useful life of 15 years like we read on the IRS site, some of these could be zero, but some of these aren't. Now the ones that are the parks that you still have some value left in are can be deducted. Like if you sell this park for whatever amount in the future, you can take $590,000 against that. So your profit is the total amount you sell it for less whatever this number ends up being. Now I'm wondering, so we probably can do a split. How are we going to do this actually? So each of these actually has separate exit values. If you look at the monthly detail, I put, let's just go to the first one. Exit disbursement. So in the very last month, you'd have that one there, that one there, that one there. Each one's a little bit higher just because of they have different other income values. So this number, let's say Mobile Home Park 1, sells for $8 million in November 2037. You've got no depreciation basis, so the 8 million is just going to other comprehensive income as far as taxes are concerned, I believe. Well, let's see. Let's see what we can find here. Taxes on selling a mobile home. And we're assuming you're just selling the park itself. And then if there's any value left, I guess there could be the parks. Okay, let's just go here. So this is just if individuals, if more than $10,000 cash is exchanged, obviously, I'm looking for an entire mobile home park. Tax strategies. So mobile home park improvements. Improvements are often allocated 50 to 75% total purchase price for tax purposes. Okay, I get that. Yep, accelerating depreciation, 15 years. Yep, yep. They generate outside cash flow returns, but most often tax-free. When the infrastructure is fully depreciated, the basis can simply be transferred to another asset via 1031 exchange. Of course, if the property is sold, if the property is sold, capital gains and depreciation recapture taxes, 25% would be owed. Okay. Okay, so here's what I think we do. We say we have an input here that says, now it's going to be different for everybody, but we're trying to put some tax logic in here. So taxes on sale, taxes on exit, selling the parks, operations, operating the income, because they might be different. So we're going to say like that just said 25%. Let's say this is whatever. We can put them both at 25. Well, no, let's say operating income. If it's high enough, it could be taxed at like 40 or 35% if you start making profits. Again, it's probably going to not happen until after you stop building new parks and are just running cash flow positive for a while. But let's say, or profit positive. Let's say that's just regular, ordinary income tax, whatever that might be. And then selling the parks is going to be different rates. So we have two rates here. Now, the taxable income, we're going to put two tax amounts in here. We're going to do tax on operating activities and tax on sale separate. So tax on operating activities is going, and we got to do this on the annual as well. That's fine. We're going to clear all this out anyway. All right, this is going a little bit smoother than I figured. This is good. This is good because I didn't know how this part was going to shake out. So we got tax on sale, and so in this case we need another calculation in here after depreciation that says earnings before tax. Let's see, earnings before interest, tax. So we'll go EBITDA minus interest for the period minus depreciation. So that is taxable operating income. So if this is positive for any year, then there's going to be a tax rate applied to that. We'll have to adjust depreciation as well to match our end month. That's fine. We'll figure that out probably tomorrow. So taxable operating income, and then, yeah, we're just going to redo all this logic here. And then we've got taxable sales proceeds. Now that is just going to be, let's see, do we have this on the monthly detail anywhere? Total sales proceeds. I know we have it here, exit disbursement. Um, let's see. Oh, exit proceeds. Perfect. Now, hopefully, yeah, I can do principal and interest separately. Nice. Okay, that's good. All right, exit proceeds are all right there in row 1905. Perfect, perfect, perfect. So we have this is on exit. You sell everything that is owned, and then that's got its own tax rate that we're going to offset against any depreciation, any final cost basis remaining. In this case, it'd be $8 million left, so it'd be the total sales proceeds minus this times the tax rate times this tax rate, and then operating income is taxed at this tax rate, whatever that might be, and that would be based on your earnings after accounting for basically that's net operating income less interest less depreciation. So we have other operating income, total sales proceeds. We don't need this. We'll have tax on sale, tax on operating activities, and then net income is the amount after that. And then that'll flow, and then that all flows to the balance sheet, and we should be good to go. Okay, so we got a way forward. I'm going to save this. We're going to stop for the day. Tomorrow, I'm just going to keep working on this. I believe we're on a good path. Don't forget to check out smarthelping.com for hundreds of different financial models and tools for all industries. Remember, you can get the template bundle. You can buy every template on the entire site for $999. Tons of value there. Or you could buy by category or individually. There's just so much value here for all kinds of different businesses, use cases, accounting, HR. We got a lot of cash flow waterfalls here, different ones, SaaS, real estate. So hop on over there.